Welcome. This is Mel with the High Speed Trading Company, and today we're going to look at PD arrays, a high level look at the PD arrays, the 7 of them. This is lesson 5 of the High Speed Trading Academy. I am happy that you're here with me, and with that, let's get into it. This is for educational purposes only, so hopefully you can get some value out of this, and you can hit the like button, hit the subscribe button. It is greatly appreciated. The objectives today are to begin to get you familiar with what the PD arrays are, the 7 types of PD arrays. And these will vary from chart to chart, from time to time. The important thing that you need to understand about PD arrays is that they are fractal. You will find PD arrays on a monthly chart, a weekly chart. You will find them on a daily chart, a 4-hour chart, all the way down to a 1-second chart, literally. So they do carry more weight on a 1-hour chart than they would on, let's say, a 5-minute chart. But just know they're fractal. Hopefully we can help you identify what these PD arrays are. And so you'll be able to go to a chart and go, oh, I see that, I understand that, and be able to identify them. And then also how these PD arrays will be used for trading. We will talk just about that a little bit. Mostly what you need to know is that we will be going over all of these PD arrays in more detail on an intermediate and advanced lessons in the future. So this is just a high-level look to get you familiar with what they are, so you can go back into your charts and begin to identify them. There's 7 PD arrays. Old highs and lows. I put in there that time-based liquidity. That's the most key levels of old highs and old lows. But we'll talk about them more on when we get there. Rejection blocks, number 2. Number 3, bullish, bearish order blocks. Number 4, fair value gaps. Number 5, liquidity voids. Number 6, breaker blocks. And number 7, mitigation blocks. It is good to note that this is all based on the order of importance. An old high and old lows carry more weight than a mitigation block. So that's just a good thing for you to keep in the back of your mind. Old highs and old lows. It's very simply that. When you look at a chart, you can identify old highs and old lows. And if you look, old highs, old lows, they tend to get swept. There's liquidity above here. This is, and that's why time-based is so important. There's so much liquidity above this level right here that the market wants to come into that level and take those stops that have been placed above here. Or if sell orders have been placed, it wants to be able to come up, place sell orders, take out their stops, get the retail RICs out of the market, and so it could move the price back down to where their objective is. Here we have a lower low or a low, and we mark that out. People are getting, this price is coming down, it's going up, we get a big candle, they think, okay, it's going long, they get in, comes down, it doesn't touch that liquidity level again, so therefore they're even more convinced, so more people go long, more stops are placed under here, eventually price coming down and taking out all those stops. A lot of liquidity right here. Old highs and old lows. Rejection block. A rejection block is very simply a wick of a candle that has made a new low or a new high, and that long wick is a good example. Let me say that, like this candle right here, it's a bigger wick. That's a bigger rejection block than what you may see right here. So this will tend to carry more weight than, say, this one right here. But we also have one right here. We have a new low being made. If we were to draw from the close, the open of this candle over and the low of this candle low, that is a rejection block. And what we know is that in the mean threshold, which is 50% of the rejection block, that price is going to tend to respect that 50% level. Meaning, we don't want to see a candle close above that 50% level, or that tells us that that wick is likely to get traded above in this case, or in this case traded below. But if we were to draw a line at 50%, notice how price comes down, does not close below that. It does wick down to below it, back up, and now we have this. That tells us that's a very, in this case, a very bullish signature that price is going to go up. And that's exactly what it did. In this case, we can see here, price comes up, does not close above that 50% level, comes back down. We can then stay right here, feel with confidence that this is going to go lower. Order blocks. We will talk a lot about order blocks. Order blocks are used in so many different ways. But for now, let's just, what is an order block? An order block is a change in the state of delivery. If you look at any time where a market is moving in a direction and then you see a down close in the other direction, a candle with a down close in the other direction, that tends to be an order block. Not in every case. And of course, it depends on the narrative of what price is doing. But in this case, we're just looking at a real simple one. Price is coming down, it makes a new low, comes up, makes a new high, comes down, and then comes back down, goes back up. So what do we notice? This last down candle before the new high was made, the move to the new high, that becomes an order block. That order block, then if we were to draw a level at 50% of that, becomes the CE, or the mean threshold. Just like I talked about in the rejection blocks, that should not close below 50% of that. If it does, then it tells us that we're not as bearish as what we thought. But because it did not close below the 50%, it rejected that level and actually closed, came down, rejected, closed above, opened up, came down, again rejected. That's a very bullish signature that price is going to go up. So we will talk more about order blocks in future videos. Fair value gaps. We've already talked about fair value gaps a little bit. Fair value gap is a 3-bar pattern where you have the wicks of the first candle and the wicks of the third candle do not touch. They do not touch. That creates a fair value gap. Fair value gaps are an imbalance that price will tend to want to return to. In this case, we see a displacement candle up, creates a fair value gap. That tends to be a bullish signature. We now have price that comes down into that created fair value gap. And if we were to draw a line 50% from here to here, see how that's almost right at 50%. It respected that and did not close below it. Again, more bullishness being shown. Comes back up, again wicks down into it, and then takes off. We will talk about fair value gaps a lot. You will use them a lot in your trading. They're a very strong imbalance that are easy to spot and very simply can tell you a lot about where price is going and what price is doing. Liquidity void is very simply when you have an area within the market that is not traded within. Here we have a close on this candle, and then we have an open on this candle. This is a liquidity void. And so it is good to note that liquidity voids tend to always be filled in. May not be filled in right away. In this case, this is a 5-minute chart. This case, it came down and filled this within about 30 minutes, 30 minutes to an hour, if we were to count these bars. So it opened up here, basically then traded down and filled that void. It is a strong magnet for price because liquidity voids represent an area where there was no trading. So those are areas that are very strong magnet for price to want to go back to. It may not go back to it for a day, may not go back to it for an hour, may not go back to it for a week, could be a month, could be even longer, but they tend to always get filled in. A breaker block. A breaker block is basically an order block. If we were to look at this as price goes up, we would say, well, that's an order block. But we notice that price comes up, then trades down through it. As it trades through it, it then classifies this as a breaker block. If we draw a line 50% between this last down candle, between the open and the close, and we look at that price, see how price respects that? It doesn't close above. It did close above here, but it quickly came back down. This is allowable. If we watch and see it up basically one, after it closes below the first time, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times it hits that mean threshold and is rejected before it goes down. That's a very bearish signature when we see that. More on breaker blocks as we go. Breaker blocks are another one that you will use often. I found for me they were a little bit harder to spot in the beginning, but we'll show you some more advanced techniques to help you find those breaker blocks so you can use them and help your trading become more successful. Mitigation block. Now, a mitigation block is basically a breaker block that does not, let's go back to the breaker block. If we look at the breaker block, this price came down, and if we were to look over here to the left, we would probably see a price level here of an old high or an old low. This is coming down, taking out the liquidity, and then moving up. In a rejection block, it doesn't necessarily take out that old low. So here we have a low, price comes up, makes a high, comes up here and fails to take out this low. That's a failure swing. It failed to make a new low, and then moves up, and then again creates a market structure shift above this high right here. That makes this bar that made this high a rejection block. Price will always tend to respect that 50% level of that mitigation block. So here we got price comes up, consolidates a little bit, but you notice how it comes down into this, and it never, in this case, it doesn't even wick below. And we come over here to the next day, and we see it respects it here, and then with this is a news candle, and notice how the news candle opens up, closes down, goes down, creates a wick, goes back up, never closed below that, and then price took off. That's a mitigation block. Again, just a high level look at all these, and we will go over these more and more and more, and you will become very familiar with them. I personally don't use mitigation blocks a lot, very simply because I'll use breaker blocks, in this case, while we have a mitigation block, create a lower, you notice how it's respecting that. This is bullish. So it's telling us that price is wanting to go up. I don't always use, because I also, if you look here, there's a fair value gap there. And we'll look at other things and other signatures that will begin to make more sense as we go on. Again, thank you for watching this. I hope this helps. Put your comments below. I'll answer any questions that you have. Go back into your charts, look at your charts, and try to identify these 7 PD arrays. That will be so key to your trading success as you move forward, is being able to identify these. Some of them will come easy. Some of them might take a while for you to get to, but before you begin to see them. I think the fair value gap, I think, is the easiest to see right off the bat, and that can be, I think it's ICT said that you could literally quit your job just on fair value gaps. They are that important. So until next time, traders, be blessed.